From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Friday, November 17th. And here are the top market stories we're following for you at this hour. Sell the epic rally. Bank of America tells investors to offload risky assets. The bank's Michael Hartnett says headwinds are building. And oil enters a bear market. WTI down more than 20% from its September high, just ahead of a critical OPEC meeting. And APEC wraps. President Xi heads back to China on a high note as the strength of the world's #2 economic power takes the spotlight. From New York, I'm Sonali Basak, in for Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy,
Sonali, what a week. What a week. Honestly, it's great to see you on a Friday, but I'm not sure Fridays, the market kind of wants the market to close right now. It has been an incredible week. Stocks are up massively, and it's the bond market that's really having a great week. Can it go much further, and does this feel like FOMO?
Does it feel like FOMO? And you look at just how much the bond market has rallied, and you wonder if that inflation print was a head fake. Guess what, Guy? Next week, we get a ton of minutes from central banks, and you have to wonder whether the liquidity squeeze next week with the big holiday in the United States makes this November just a little choppier.
Yeah, I think you're going to get some turbulence after the kind of the weeks that we've had. 3 weeks up potentially for the S&P. I know we're fading it a little bit today, but not by much. We're down just a touch. The DAX is up by 4.5% this week in Germany. The Russell, your side of the pond, up 5%. These are big numbers. And I do wonder whether there is going to come a point fairly soon where, as you say, it starts to get really choppy. Takes us to our question of the day, Sonali. What do? Do you take the Hartnett view? Do you fade? And we've left the word epic out here. Do you fade this epic rally? Let's try and figure that one out. Joining us to discuss, Bloomberg's Edward Harrison and Bloomberg's Christine Aquino of Bloomberg M Live. Let's talk about this, guys. Christine, let me start with you. What do you think? Fade the rally?
Well, Guy, it's kind of hard to stand in a way of a Santa rally that's also being juiced up by a Goldilocks environment. And that's exactly what we're seeing here, right? There is that seasonal impetus to be positive on equity specifically during this time of year. We know that this comes every year. And then, of course, now we also have this environment where the U.S. economy, by most measures, is actually just right. Inflation is cooling a little bit. Yes, the job market is also cooling a little bit, but not to an extent where it is going to be worrying policymakers. And you know what? I was arguing earlier this morning in a 5 Things newsletter. This is the kind of economy that most other central banks and the rest of the world trying to strike that balance between growth and inflation could really only dream about. And the U.S. has it. And so when you have that kind of environment, I mean, what reason do you have to stand in a way of the stock rally that we're seeing at the moment?
You know, you think also about this idea of oil entering a bear market. Ed, come in here. Do you think that the oil market is saying something that the stock market is not?
Yeah, I think it definitely is, Sonali, because the interesting bit, I'd have to agree with Christine that it's hard to get in front of this when everyone's so bullish. But obviously, there are 2 messages that are coming out. You have oil going down, and you have stocks and bonds rallying. So how do we look at that? You could look at that as an inflation play, i.e., oil's going down, inflation's therefore going to come down. The Fed, knowing that real interest rates are going to go up, they're going to cut. And as a result, all is fine and well, and that's good for equities. But another potential outcome that we're getting from oil is that the softness is getting to be too much, and that's what Michael Hartnett is talking about, and that's negative for equities but positive for bonds.
Ed, how long are we going to be in the phase where, yes, we've got sort of Santa and Goldilocks colliding, which is quite the combination. But how long are we going to be in the phase where lower yields are taken as a good thing rather than a bad thing? I.e., lower yields are there because the economy is slowing. At the moment, the market is taking it as a kind of discount rate story. And as a result of which stocks can rally on a multiple basis. But what point does the kind of the economic story kick in?
Yeah, I mean, that's a great question, Guy, because I think that, it's a fine edge between slowing and slowing into a recession. Right now we're at this point where people are saying, okay, there was a earnings recession, but that's over, and we're going to slow, but we're actually going to do well on an EPS basis going forward. The problem, however, is if the slowing that we see when we look at jobless claims, continuing claims in particular, if that tips over into a recession. We have 3.4% as the low for this particular cycle on the unemployment rate. We're now 3.9%. The sum rule, where you go up 0.5% in an unemployment leading to a recession, is already in play. So the question is the Psalm rule going to be activated as it has been in prior episodes?
Christine, let's talk about head fakes here for a minute, because you look at the breadth of the market and just how much the NASDAQ 100 has risen relative to the S&P this month, and how weak the Russell 2000 has performed. Do you think that means there could be a greater bid in the future into the S&P's other stocks besides the Magnificent Seven, the Russell 2000, or do you think that those weaknesses are showing more pain to come?
Yeah, good question, Shonali. I mean, I think there is room for some of the sectors in the S&P 500 that have been left behind by the Magnificent Seven to catch up, just because there is a kind of realization now that perhaps that soft landing narrative starting to gain a lot more traction, right? Again, we saw kind of the broad-based measure of inflation as well as labor markets this weekend over the last couple of weeks. The sum of the data that we have seen is, in fact, that prices in a lot of parts of the economy are cooling. You know, we look at producer prices, we look at consumer prices. There's definitely a moderation there. So that's definitely good news for consumers and companies alike. Job market's moderating a little bit with those jobless claims ticking higher, but then some of the survey data backing up this relatively still positive sentiment in the economy. And so, you know, again, moving into the end of the year, the Santa rally, very powerful, definitely has the potential to lift all boats apart from the high growth tech sector that everyone loves.
Edward, Christine talks about the fact that sentiment in the economy is still good. Is that what we are learning off earnings calls, though? Because if you want to get an idea of what's going to happen next, you don't look at the rear mirror, i.e. at the data, you look through the windscreen. And through the windscreen, corporate CEOs, the calls that we're listening to, are telling us that maybe the economy is slowing, that the consumer is beginning to crack, that things aren't maybe as rosy as they were, that the top line is beginning to move into a different gear, i.e. a lower gear. Is that where we should be looking in terms of what happens next? And does that fit with the seasonality and the rally that we're seeing?
I mean, yeah, you look
Yeah,
like...
Was that Christine or was that for me? Let me say that my answer to that would be that if you look at Cisco and Burberry in particular, those are two companies that I think are representative of how to think about it. Cisco in terms of where corporates are, Burberry in terms of where sort of the upper income people are, and those are the people who actually have the savings from the pandemic that are still in play, that are keeping the economy afloat. And both of those companies are saying that there's weakness. And you know, going back to your previous question, Guy, the question is it weakness or is it weakness into recession? We still don't know. The numbers aren't telling us that at this point yet. And that's the big question for 2024. Is it just weakness or is it weakness into a recession?
Hey, Ed, how much is this contingent on a bond market rally? You look at just how much yields have come down and big tech has flown through the roof. Is this bond rally even sustainable?
Yeah, and that's a great question, because next week we're going to get a 20-year bond that's going to be opened. We're going to get a reopening of a TIPS bond, and this is in a Thanksgiving week in the United States that's going to have, you know, fairly thin trading, and so that's going to be a big test to whether or not people want duration at these particular prices. We're already at 440 on the 10-year. Is that enticing? We'll find out next week.
Our thanks to Bloomberg's Ed Harrison and Christine Aquino of Bloomberg M Live. Now, coming up, more on our question of the day. Fade the rally? Liz Ann Saunders, Chief Investment Strategist at Charles Schwab, joins us next. This is Bloomberg.
we're at this inflection point.
In the midst of this slowdown,
there's some pretty significant headwinds.
Seeing those cracks in the consumer.
Consumers are under increasing pressure.
Their wallet is very much under pressure.
The data we've gotten over the past couple of weeks have been on the softer side.
The data is cooling. The economy's decelerating.
There has been this slide in oil prices.
I don't think you want to take all of the probability weight off of the chance that the Fed has more work to do.
The Fed needs to keep the market on its back foot.
Does face a very tricky balancing act.
A soft landing is incredibly difficult to pull off.
People are going to get nervous about the state of the economy.
We still don't know if it's a soft landing or a graded downturn.
The real question is are we going to have a slowdown or a soft landing or a recession?
This is a soft landing year.
Soft landings never last forever.
Those were some of the top voices speaking with Bloomberg about the chance of a soft landing. Now let's get back to the question of the day. Do you fade the rally? Joining us now is Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. Liz Ann, if you think about what is possible to fade in a market that's been pretty exuberant, what can you sell at this point?
So I think you want to fade down the quality spectrum. You know, we saw this unbelievable lift with small caps. Russell 2000 is the primary benchmark associated with that, particularly on the day of the better than expected CPI report with a 5% or so move higher. And that's a big index. It has a bit less than 2,000 stocks in it. But yeah, it might be a monolith from an index perspective, but you have a lot of lower quality stocks. I know you guys were reporting earlier today about the 40% of stocks are non-profitable, 30% of the Russell 2000 are zombie companies. And I think that's the area within any index that you want to stay decidedly away from and focus more on quality broadly, but specific factors like high interest coverage, low interest expense, strong return on equity, positive earnings trends, positive earnings revisions, and those factors sort of have a quality wrapper around them. That's the way I'd approach this point in the cycle.
Liz Ann, the issue, though, is that once the market gets a little bit of momentum and people start getting sucked in, you're off to the races, and that kind of feels like what the last couple of weeks have been about. Why would it stop now? What is it that's going to stop this? The seasonality story is with us. You basically got Santa Claus colliding with Goldilocks. How long could that last?
So I think what clearly has been the case in the last few months is bond yields in the driver's seat for the equity market. You saw it on the downside with correction level declines when you had the surge up to 5% in the 10-year, and then you saw the rally since those correction lows, courtesy of the move back down to sub 4.5. I actually think we're at a point where what equities would favor most is stability in bond yields. Clearly, another shot up in bond yields, either because of upcoming hotter inflation data or much stronger growth data. I'm not sure that's likely, but that would not be met well with equities. I also think that a significant move down in bond yields, particularly if it's accompanied by or driven by much weaker economic data, would also not be good. So I think the right ingredient now for a continuation of this rally as it relates to bond yields is stability and not big moves in either direction.
Liz Ann, it begs the question, you look at all the rate cut expectations seeping into the market, and what's the risk here that yields do fly higher?
Well, I'm not sure how realistic those expectations are. By the way, they haven't been realistic for quite some time. You know, back in March when we had the mini banking crisis, you had an expectation that the Fed would already be cutting at this point. That's continually had to be pushed out. If you were to extrapolate the current set of circumstances, and I'm not suggesting that's appropriate to do, but just the exercise is if you look at the current set of circumstances, inflation still above the Fed's target, some loosening in the labor market, but not any serious cracks, the economy hanging in there, that simply doesn't justify a pivot from the most aggressive tightening cycle to actual rate cuts. It may perfectly justify a pause based on what inflation has done, but I think it's premature to look at market expectations of rate cuts starting in May as locked in. I also sometimes say be careful what you wish for, because I think conditions that would give the green light for the Fed to start cutting as soon as before the midpoint of next year, I'm not sure are the most pleasant of circumstances.
Liz, my takeaway from the earnings season has been that the top line's beginning to fade. Margins are being protected by the start of a cost-cutting story, which is keeping kind of the bottom of the P&L, the profit line, looking okay. How much longer can the kind of the middle and the cost-cutting story protect the bottom line, do you think?
Well, and you're right to point that out, because you had a very strong earnings season in terms of the earnings beat rate, but the revenue beat rate was much lower, and you didn't see strong performance even by companies that double beat. And it's because of the underlying message of cost cutting in order to protect margins and the bottom line. I think probably the most important story is what happened to fourth quarter estimates. Analysts are being much nearer term as it relates to forward adjustments, sort of just the next quarter out. And whereas you went from an expectation of only about 1% earnings growth for the third quarter, that's now moved up to about 6% on a blended basis. But it's been the mirror image for the fourth quarter. You've seen the consensus go from up 11% to now up less than 6%. And so I think that outlook story, as it relates to what companies have been saying, has not been as positive a story as what you would glean if you simply looked at the backward nature of a better than expected from a beat rate perspective. So I think it's certainly still the story going into fourth quarter and into the first part of next year.
There's also the cross current here in oil prices, and you look at the bear market you're seeing in oil prices. What is that telling you about the strength of the economy?
Well, there's certainly a big part of the supply side and less concerns about limited supply or supply disruptions. But the question is there also a demand part of that bear market story in oil? That's been getting less attention. And given that oil moves up and down in terms of demand at the global level, just not the U.S. level, we know we're seeing signs of weakness in economic growth, certainly in places like China. So I think that there is probably a bigger part of the story that's on the demand side. It's not just a supply story. And that's an important macro tell.
Lizanne, I'm sitting in cash. Do I come out of cash? And if I'm coming out of cash, where am I going?
Well, it depends on who you are as an investor. If you asked me that and you were 25 years old and you just inherited $10 million and you don't need to earn income on it and you're not going to freak out at a 10% or 15% drop, I'd say, yeah, go risk on. If you're a 75-year-old investor and you have an nest egg and you can't afford to lose any of the principal and you need to live on the income, what I would say is entirely different. So I actually always think shame on you if you provide sort of a simplistic numerical percentage answer to a question like that, because who's the investor?
Well, this is going to be annoying too then on a numerical percentage. Where do you think Fed funds end next year? Because goodness knows the estimates are all over the place.
I have no idea. It depends on the data. I already said I think it may be premature to assume cuts as soon as May. But if we see more economic deterioration, and by the way, I think recession sooner rather than later. Somebody said you get to choose whether it starts in the fourth quarter of 23 or fourth quarter of 24. I think sooner rather than later is better, because it allows the Fed to not just take their foot off the economic brake, but actually consider moving into easier policy. So they're data dependent, which means we're all data dependent as it relates to trying to forecast that far out where the Fed funds rate is going to be. I think they're done for now. It's just a question of how quickly they pivot to the cut side of things.
Great to see you. Have a great weekend. Lizanne Saunders and Charles Schwab. Thank you very much indeed. Still ahead, big name advertisers pull out from X. This, of course, after Elon Musk endorsed an anti-Semitic post. Details on the implications, the fallout from that. That's next. This is Bloomberg.
It's 7:20 on the West Coast. So let's get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg technology co-host Ed Ludlow. Ed, let's start with this story on Elon Musk and these posts that have been on Twitter. Very many concerns from advertisers about endorsing anti-Semitic views. IBM, the European Commission, and it's not just X. How much of an impact is this going to have on X and Elon Musk's larger enterprises here?
It's a very hard question to answer. What happened is that Musk made a post on X, the platform formerly known as Twitter, which agreed with another user's post, which stated that Jewish people hold a, quote, dialectical hatred of white people. Musk then did a follow-up post where he said, to another user's statement that they've spoken the actual truth. That's what happened on Thursday. And you'll note that in the public markets, Tesla fell almost 4% yesterday. It's chopping around Friday, but it's down again. What I'm hearing is that IBM has paused advertising on X, right? It's in response to a Media Matters report, which was published Thursday. And the Media Matters report was basically an analysis, a study, which they say showed that big name tech accounts saw their advertisements appear in feeds alongside pro-Nazi posts. And X, the company formerly known as Twitter, has responded. They've written to me this morning explaining that basically what is happening is that those ads are showing up following the users that are conducting the research. And thanks for bearing with me on this one, guys. It's not straightforward. That basically the Media Matters researchers that went and did the study, what they found reflects their own user base and user preferences. That is the argument that X is making. And just real quick, Guy, I think it's of interest to you. I've just been told that even though the European Commission has hit pause on advertising for now, they'd only spent $5,000 year to date anyway advertising on X, which to me seems an incredibly small amount.
It probably is. Well, it is a small amount, but maybe it's not representative of the impact that the European Commission saying it's not going to advertise anymore would have. I appreciate that it's a relatively small amount, which is why X is maybe giving us that number to try and reduce the impact. The common feature of all of the platforms, Tesla, SpaceX, X, is Elon Musk. How problematic is an issue on X for the other parts of the business? You talked about the Tesla share price drop.
Right. Well, remember the story that we've been covering on this segment for the last few weeks, which is Elon Inc., right? That there is a very close relationship between publicly traded Tesla, X, the company formerly known as Twitter, and XAI. It is very common for Elon Musk to put into place talent sharing, where employees of one company transfer over and work at another. What we don't know this, but we're trying to find out at Bloomberg News, is what those employees, because if you add all of his companies together, he's employing 150,000 people around the world. How do they respond to all of this? I'd also note, specifically in the context of Tesla, right, the share's under pressure. On the week, it's actually up significantly. But there are loads of very pro-Elon Musk, pro-Tesla and Tesla shareholders that have taken to X in support of Elon in the last 24 hours. So it's an incredibly muddy situation to cover.
Ed, great coverage, though. We'll look forward to more of it when we get to Bloomberg Technology a little later. Ed Ludlow, Ed Caroline, Bloomberg Technology in around 90 minutes' time. I know that we're back to this issue, and as Ed says, relatively complicated. What are we going to do next? Big-name retailers out with earnings this week, and the signal is that they're getting worried about the strength of the U.S. consumer. More on that next. This is Bloomberg.
We're an hour into the U.S. trading session, and Bloomberg's Abigail Doolittle is tracking the moves.
So, Shonali, for the S&P 500, we really don't have all that much going on, as you can see, and that's true for most of the indexes. But the Russell 2000, which underperformed yesterday after outperforming big time earlier in the week, outperforming again, up 1.3%, although still below that important level of resistance that we looked at yesterday. You can see a bigger move than most of the stock indexes happening in bonds. We have yields rising, bonds selling off a little bit, but the 2-year yield below 4.90, a big drop on the week. We'll be taking a look at that in a moment. And then take a look at the dollar, also weak, down 0.3%. Now, in the weeks, days, even months ahead, I think the dollar could be a big driver for risk assets and stocks in particular. If we take a look at the Bloomberg Dollar Index, in the near term, it looks like we could, in fact, see a move higher. This is the Bloomberg Dollar Index, and this descending range, the way that it converges, it typically is bullish. That's matched by an RSI that's almost oversold, suggesting we could see the dollar rise. I would argue, though, in the medium to long long term, it looks as though the dollar may be making a big decline, which would actually match the forecast, the idea that the markets have that the Fed will be cutting, even though yields don't necessarily tell that story, given the fact that they are still holding on to support and look like they will continue to. Now, on the week, if we put all of this together, what we're looking at is the Bloomberg Dollar Index heading to its worst week since July. We have yields backing down in a big way, the 2-year yield down the most in several weeks. And then take a look at stocks. Here's this week, this big week for the Russell 2000, up 5.3%. The S&P 500 up for a third week in a row, the first time we have seen that since July. As for some of the movers on the day, all about retail, or mainly about retail, I should say. BJ Wholesale Club down 2.5%. They beat, but the comp sale, the growth looking forward, not so great. Talking about some weakness for the consumer. Ross Stores up 8.4%. Really impressive results there. And then the Gap, my gosh, look at this, up 29%. The last time I looked, it was the best day since March. This may be outpaced above that, but they, of course, beat earnings by about 52%, putting up, 210%, putting up 59 cents per share, having a lot to do with better inventory strength out of Old Navy, offsetting some of the weakness at the other brands.
Abigail, perfect. Thank you very much indeed. Great setup. Abigail Doolittle, what's happening in these markets? What's happening with these retailers? Let's talk more about what retail results say about the consumer. This time next week, it'll be Black Friday. Erin Sykes, Nest Seeker's international chief economist, joins us now. Nest Seeker's residential commercial brokerage firm. Erin, great to see you. So this time next week, it's going to be Black Friday. What kind of a consumer is going to show up to Black Friday, do you think?
Well, we're coming off of some positive news in the previous weeks. We've got mortgage rates down. We have a rally in the stock market. We have people coming into their year-end bonuses, starting tax planning, generally a positive mindset. But I think it's a little too early to say that this is going to be a momentous Black Friday. And I think we're going to consider a win if we hit the same numbers as last year. And that's because prices are obviously higher. And even though we're seeing a moderation in inflation, we still have those persistent prices. And people are carrying the highest credit card balances in history. They're paying 22% on those credit card balances. They are paying 19% on their insurance, a 19% increase on their insurance. And they are just feeling that pressure that took a while to get here, but it is definitely on all of our shoulders right now.
How much of a crunch do you think that these consumers are going to hit into the holiday season as well? And does it mean that many more retailers are going to have to come in with steeper and steeper discounts?
I think we've already seen those discounts. We saw Amazon host a second Prime Day in October. That pulled forward a lot of demand, not only for all of holiday shopping, but for Amazon in particular. So we have these benchmarks that are going to be very challenging to hit again. And I think that sets us up for some, frankly, disappointing news come holiday season. That said, I think this is the last hurrah. I think people are saying, let me just get through the holiday. I do expect that bonus to come in. Let me make my family have this one last moment before I really batten down the hatches and tighten my wallet.
What does that look like? Just give me a sense of the order of magnitude of that tightening of the wallet you think we're expecting to see in 2024.
So we talk about all different things right now in terms of the timing of rates pulling back, and we're looking into the second quarter of next year. And really nobody has a crystal ball. And I think that the intelligent thing right now is for consumers to lay low. And I think that they recognize that as well. And we saw that in the housing market, where we've seen sales moderate, particularly over the last 3 months. It's as if that market came to a screeching halt, but the consumer continued to hold on. That was kind of the last viable crux that we had in this market. So as soon as that consumer falls off, then we're going to see, more challenging days ahead. That said, I don't think that the second quarter of next year is any type of magic timeline. I think it's really an arbitrary planning purpose right now. So if we look back, to a year and a half ago, we were all saying that inflation is transitory. So, we have to really take into consideration where we see our personal situations, look at our neighbors around us, and everybody is tightening their belts right now. So I think, the IRL, the in real life statistics are sometimes more important than those that we pull from our macro charts.
Erin, what types of retailers do you think are going to feel the brunt of that pain?
So the ones that have increasing or have changeability in their rates, particularly commercial real estate, has been a big challenge right now. So if we look at Macy's, Macy's owns a lot of their stores, and this has really been what has allowed them to hold on over the past few years when we've seen challenging sales. Basically, they have lower overhead. So the stores that have the higher overhead, big spaces, variable rates, it's really hard for them to make a profit. Ones that I particularly see that will do well are those like TJX. And I think that as we start to buckle those belt buckles and pull back our wallets, we still want to shop. We still want to have that, feeling of satisfaction. And TJX and discount stores are where we're going to migrate. Also, we've got the lipstick effect, and Estee Lauder has seen challenges because of their focus on China. But I do see people floating back into beauty because you can get high luxury items for $20, $30, $50, maybe $100 versus going into clothing departments and, paying 4 times that for the same feeling of luxury satisfaction.
Apparently, looking after your skin is important, Erin. People tell me on this show. Erin, do you think consumers expect that prices at some point will actually start coming down? There's a lot of talk at the moment of disinflation, but that's not deflation. It's just a slowing of the price rises. How do you think the consumer perceives inflation at the moment? And is there an expectation of lower prices maybe in the future?
So we constantly deal with a recency bias where we reflect on what we've seen in the most recent months. And it took us a minute to get over those ultra low rates and relatively low prices that we had for so long, and now finally accept these higher prices. And I think that once retailers see that the consumer is accepting higher prices, then you switch from from inflation into greedflation, which is, basically taking advantage of an inflationary environment and just adding, extra pricing power because you can, because you have some type of monopoly over that particular item or that particular consumer. So we are seeing that, and that is a short-term solution. You will see returns for those retailers that are taking advantage of consumers. You'll see them make money in the short term, but in the longer term, they will lose that loyalty of the consumer. So I always reflect on the long term, and I think it's really important to take care of your consumer and to not to price gouge.
Our thanks to Erin Sykes of Nest Seekers International. Coming up, oil sinks into a bear market. More on what's driving the slump next. This is Bloomberg. In today's ETF Friday, we're looking at Cathie Wood's ARK Innovation ETF. It's on track for its best week of flows since 2022. And joining us now is Bloomberg's Emily Graffeo to talk about it. Is it sustainable?
Well, that's a good question. According to Cathie Wood, it is. She was on BTV earlier this week talking about how she sees deflation and that will propel her fund farther. But it's interesting because the fund is up. It's having a good year, up a little bit over 30% year to date, but it's underperforming the NASDAQ 100 because that index has really been propelled by the Magnificent Seven. And to Cathie's defense, that's not really her thing. She really invests more in disruptive companies. So she doesn't have any exposure to NVIDIA, Microsoft, Apple, but she has some smaller names, think Coinbase, Roku. So underperforming, but still a much stronger year than she's had in the last 2 years.
Emily, I'm hearing more and more people talking about the fact they're looking for active. Maybe they're looking for an active ETF. If they're not going to ARK, where are they going?
They're going to a different kind of active, Guy. We're seeing about $100 billion this year flow into active strategies in the ETF world, but most of the flows are going to covered call strategies from JP Morgan, systematic strategies from Dimensional. So these are active funds, but they're not the conventional kind of stock picking, high conviction style active that Cathie Wood takes on, but it's more rules-based strategy where the fund manager might just tinker the rules and the methodology a little bit, but they're not sitting there every single day picking and going in and out of a stock like Cathie Wood is.
It's a good point that you made about her not being exposed to those kind of big tech names. But the deflation call, did she give a sense on when it would play out? Because the reality is Cathie Wood has been talking about deflation for years.
That's right. She really has. On BTV, she did say that she sees inflation turning negative, at least the inflation rate, at some point in 2024, which is kind of above the consensus expectations for when we will see deflation. She also said she expects a rate cut. Of course, that macro environment would be very good for her funds. So she has a reason to kind of talk about that.
Oh, yeah. Emily, great stuff. Happy Friday. Thanks for joining us. Emily Grafeo on ETF Friday. Let's talk about what's been happening in the crude markets. And Shonali's been raising this with our guests throughout the program already. Oil is heading for its fourth weekly loss. And the move over the last 24 hours has been really quite significant. And it takes us to a place where OPEC may have to react. We've got the meeting coming up in Vienna. We're at the kind of level where I think we're going to see some issues. So how is OPEC ultimately going to deal with this? Julia Fanzeras joins us now to discuss. How do we think OPEC's going to deal with this, Julia? The ball feels like it's now in their court.
It absolutely is. And OPEC, ahead of this meeting, has said that this price drop has been because of speculators, algorithms, and trend followers, and not exactly because of crude fundamentals. So it's likely that they may stay the course in trying to say, no, the markets still have enough demand, and there is going to be enough supply, and the market still needs to rally. So I do believe that OPEC does have it in their court, but also sees that there is enough demand.
So that is OPEC's point of view. But what is the case for the other side here on a demand shock part of the picture for oil?
I think it isn't as much of a demand as a supply. Right now, the U.S., we saw a huge stockpile build. We're seeing more exports coming out of Russia than anticipated. So I think that a lot of traders are looking at this market and saying, we're just seeing a lot of supply on the market, and there isn't enough conviction to go higher. Sure, demand is also strong, but not as strong as all of the supply news that we are receiving.
If OPEC sticks to the message, is the market going to have another crack, though? How much lower could crude go?
Some people are saying that it could go lower, another $5, but it really does depend on if demand is going to resurface this holiday season. If we don't see strong enough demand from China and not enough strong enough demand from the U.S., we could be testing $60 with WTI, as we're now down to $74.
At what point does the oil market create a demand for a response here to kind of support prices on the higher end?
What was interesting was a trader yesterday was saying the problem is low prices are not fixing low prices. And I think that is the issue at hand, because traders, they're seeing a lot of algorithms in the market right now. So the fundamental players don't want to jump in right now when there is no conviction in the trade.
Yeah, it's interesting to kind of line it up with what's happening with the moves in the bond market that we're seeing at the moment. Julia, what are the implications in all of this for product prices? Crack spreads have been relatively wide. How quickly does this get passed on to the consumer?
The bulls still have that as the shining light. They keep saying that product demand is still very high. So you're going to see still gasoline prices are not at their historical levels, but there is still demand for these refined products. So consumers are not yet seeing a lot of relief, but it still shouldn't be the highs that we saw last year.
Julia, really nice. Thanks very much indeed for joining us. Julia Fanzeras joining us on what's happening in the oil market. We'll look for that news next week. Let's turn back to tech. We'll talk about this next. AI is already helping banks handle derivatives trading. It's helping detect fraud. It's helping with all kinds of things. Apparently, it could soon also be writing your performance review. More on today's Wall Street Beat next. This is Bloomberg. Time now for our Wall Street Beat, where we look at what's buzzing on Wall Street and in the world of banking and finance. Today we're looking at how AI is being used to potentially write your performance review on Wall Street. Now, normally we talk to Sonali about this, but she's otherwise engaged. So Jenny's joined us here. Jenny Serene, who leads our finance coverage from the UK and the Middle East. Nice to see you in here in London.
Thank you.
Sonali misses you, I'm told.
I do miss her as well.
So if I'm sitting on Wall Street, I'm getting to the end of the year, I'm wondering who's going to write my performance review. Is it going to be AI?
Yeah, I think, so what we're hearing right now is that a lot of banks are looking at using this new software that Workday has developed that will basically help managers write their performance reviews at the end of the year.
Which they love so much.
It's, you know, it's a time-consuming process. So I think what they're hoping to do is make that just a little bit more productive for these managers. So by this time next year, you might just see ChatGPT kind of weighing in and helping them out there.
Jenny, let's also talk about the reality of the situation in the market right now, because this is coming as it's tough to keep a job on Wall Street in this era. Thousands of people have been laid off this year. It's the kind of the season where everyone is getting reviewed. How much fear does this instill in people who are really worried about their reviews this year?
Yeah, I mean, I think it's a really fair question. I do think what we tend to see with these annual performance reviews anyways is that a lot of HR executives have started to question the efficacy of an annual review, and especially when it comes to, you know, rating folks on a numbers scale. And so I think in a lot of cases what this AI should help these managers do is just, you know, come up with more of the written components. You know, you feed in a little bit about what you think of that employee, and then it will kind of spit it out in a much more user-friendly and readable way. But I think there's still a lot more to come on this front, and it's really in the early stages. It's just banks expressing interest to some of these software providers, and we'll see, you know, how quickly they actually adopt.
Performance reviews take me to bonuses. One to the other.
Yep.
There's a nice story in the terminal today talking about the fact that taxes. You've got a story in the UK where more and more people and more of their earnings are being pulled into the tax bracket and they're being taxed on it. And if you look at the numbers out of the City of London, they're really quite extraordinary, particularly for an industry that this government hasn't exactly loved over recent years.
No, that's exactly right. And so this was a new report out today by UK Finance, one of the key trade associations here, really just showing that the recent fiscal drag policies that this government has had has really meant that these bankers are paying thousands of more in taxes each year. And what they're warning about is that this is really going to put London's status as a global financial center at risk. If you look at, you know, the tax rate that banks have to pay here in London versus what folks pay in New York or Amsterdam or Frankfurt, it's a really big difference. And so I think there's a major concern here.
What does it mean for the broader context of the UK's place in the financial center?
I mean, I think it's something that we've talked about a lot, not just on this program, but, you know, just more broadly. If you've got places like New York and places like Frankfurt, places like Paris really vying to have that status, you know, you worry about London losing out. And so I think that's what the UK finance folks are pointing out today is just if you've got these really high tax rates, it's something that, you know, really does put that status as a global financial center at risk.
Does it affect? It's interesting. So banker bonuses are being debated at the moment, and I'm wondering how that sort of collides with this. I'm also wondering as well about sort of issues like carried interest, where some within the finance world are paid at a very different tax rate to others, and how ultimately those gears can fit together too.
Yeah, no, I think it's a really good question. And it's interesting because, to your point, bonuses are expected to be pretty down this year. And so in a year where already your bonus is down for you to be getting taxed at an even higher rate, it just leaves a bad taste in a lot of these folks' mouth. And so I think that's definitely part of the equation too, is just how does my actual bonus picture fit into this broader discussion about fiscal drag and kind of what Rishi Sunak's government is doing.
A big wave by the sounds of things.
Yeah.
I mean, there is a fiscal drag over in the UK, but let's talk about the competition, because the reality is it's not like you live in New York and you don't have to float away the money in taxes too. So, I mean, how does that competition stack up at the end of the day, and where else do people look? How much is this a sticking point?
Yeah, I mean, I think it's interesting because I do think we tend to think of it more of like bank on bank when it comes to the competition for these bonus payments. And so it's interesting to then kind of layer on top of that the fact that where you're actually based might feed into that even more. And so the idea that these London-based bankers who are already seeing lots of competition from hedge funds and, you know, other places might also then think, okay, well, if I go to New York, that's, you know, 10 percentage point difference in terms of what tax rate I'm paying. So I think you're totally right that it's not just a London versus New York thing. It's a London versus New York banks, and then banks versus hedge funds. it's a really complex process.
Maybe I just skip New York in its entirety and go straight
Oh,
to Florida.
please.
Jenny, really nice. Thank you very much indeed. Jenny Serene joining us with the Wall Street Beat. Oh, please, some Sonali Basak. Let's look at where markets are going into this close on Friday here in Europe. Stock 600 up another 1%. It's been an incredible week. Look at the DAX. It's up by over 4.5%. It's an incredible performance for some of these European indices. Brent crude now bouncing back as well. It's had a terrible time over most of this week and is still down heavily. But a bounce back at the end of the week, maybe helping out OPEC. Is it all just the algos, or is there something fundamental here? Brent crude, 79.73. Euro dollar. European currencies have had a very, very good week. The dollar has been down. Euro dollar now trading nearly with a 109 handle. We're up by 0.3%. Zeynep Öztürk of Deutsche Bank, private bank, joining us next to discuss all of this. Do you chase the rally? Do you fade the rally? We'll talk about it next. This is Bloomberg.